What is an adjusting entry? An adjusting entry is the process of varying journal entries that were originally recorded. This is, whilst the recording transaction process begins with journal entries, the requirement of accrual basis accounting leads to the adjusting of journal entries. There are two bases of accounting, and they are defined respectively as both cash basis and accrual basis. So your cash basis is the recording of revenue when received, this being a receivement of cash or accounts receivable, and expenses when cash is paid. Accrual basis, however, is the recording of revenue when they're earned and expenses when they are incurred. An authoritative force that regulates these adjusting entries is GAAP. GAAP, or Generally Accepted Accounting Principles, are the standard procedures required by businesses within the practice of financial accounting. This is regulated by the Australian Accounting Standards Board, AASB, to ensure correct practices by businesses when recording entries, and further these financial statements. Due to this, accurate basis of accounting is required, enforcing the revenue recognition principle and matching principle. Now, accounting entries are classified into two different segments, these being deferred and accrued. Deferred is generally a beforehand receivement of payment or expense. Therefore, your deferred revenue is defined as the receiving of payment before a service is provided, and deferred expense being defined as a payment for a resource before it is generally used. Accrued is, however, vice versa, with accrued revenue defined as receiving payment after revenue is earned, and accrued expense being the incurring of an expense, however, paying later. Here's an example of both deferred revenue and deferred expense.
The process of adjusting entries for deferred expense begins with our original account being a prepaid rent that we paid in advance for cash of $12,000. Therefore, we increase our asset account and debit it by $12,000 and decrease our cash account, which credit by $12,000. However, after 3 months, we have used $3,000 worth of prepaid rent. Therefore, we decrease our prepaid rent and credit it, and increase our rent expense and debit it by $3,000. Therefore, leaving $9,000 left in our prepaid rent account. When adjusting entries for deferred revenue, we begin with our original entry of debiting cash and crediting unearned revenue by $5,000 as we have received cash for a service we haven't provided. But on the 9th of August, we have actually provided the service, therefore we debit our unearned revenue, decreasing it by $5,000, and we're actually crediting our sales revenue because that's how much we have actually earned.